This is Colin Sabrin from Nordic Financial Planning, and today I want to talk about your corporation and how having too much cash inside of it can inadvertently affect your capital gains exemption if you're planning on selling. So today in 2022, if you sell shares of your small business in Canada, you have $913,630 worth of lifetime capital gains exemption. So let's go over an example of how it would look if you were to sell your business and have a $1 million gain on the sale of your shares. So here we are, $1 million gain. The lifetime capital gains exemption is currently $913,000. So the total gain after the deduction of the capital gain exemption would be $86,370. Okay, so the tax savings in this scenario are massive because instead of paying tax on a $1 million gain, you're only paying tax on a $86,000 gain. And as you know, when it comes to capital gains, only 50% are taxable. So in this scenario, this individual will be adding about $43,000 of additional income on their tax return for 2022. Now this is where things could go wrong if you don't have your corporate structure set up properly. And today we're going to be talking about specifically having too much cash inside your corporation. So let's go over another example. Let's say you're running a business and you're being extremely successful and you're sitting on $750,000 of cash. And then on the other side of the ledger, you have your business assets, which are worth $4.25 million. So overall, your business is worth $5 million. And now you're ready to sell. You've done well, you want to take a break, you've had enough, so now you're looking to sell and you're hoping to use the capital gains exemption on the sale of your corporate shares. However, in this scenario, because you have too much cash in your corporation, your shares will not qualify for the capital gains exemption because you cannot have more than 10% of your corporate assets in non-business assets. So in our scenario here, if the corporation is worth $5 million, the most you could have in cash would be $500,000. Because this corporation has $750,000 of cash inside, it would not qualify for the lifetime capital gains exemption. So what can this business owner do? Well, they have a few options. One, they could withdraw some cash out of the corporation. However, that's going to be taxable unless they have a shareholder loan or a capital dividend, basically a way to get money out of the corporation tax-free. But if it is taxable, it's still beneficial compared to losing out on the lifetime capital gains exemption. Another option would be to simply spend some of this cash on business assets to bring your ratio in line. So maybe spend $250,000 on a business purchase so that you can reduce your cash inside your corporation. You can also look at creating an investment corporation where you can flip some of this cash inside of there. Now that's a little bit of an advanced strategy that we're not going to touch on today, but that would be an option. The point being, you need to keep an eye on how much cash you have in your corporation because failing to do so might lead to you losing the opportunity to use the capital gains exemption if you ever end up selling your business. Now be aware that many investment advisors have no idea that this rule even exists and how this works. Therefore, they'll gladly invest some money inside your corporation without putting any thought in how it's affecting your capital gains exemption if you plan on selling. Okay? So be careful when you're investing inside your corporation. Make sure that you're checking how much you have in investments because whether it's cash, investments, that's all considered non-business assets. Now, insurance agents are guilty as well. If you buy an insurance policy inside your corporation, the cash value that you have in your insurance policy is also considered a non-business asset. So again, that could also be putting your corporation offside for the lifetime capital gains exemption. So to summarize, if you want to take advantage of the capital gains exemption, you cannot have more than 10% of your assets in non-business assets when you're selling your corporate shares. Don't let this rule sneak up on you. Make sure that you're keeping track of this and that you're taking some money out if you need to, or again, purchasing assets, flowing it out to a new corporation. Failure to get this right will result in a tax bill that could be as high as $200,000 by not being able to use this exemption to lower your capital gain.